Welcome back, intermediate traders. You've already put in the screen time, right? You've got your basic COT readings down, you know exactly how to track those managed money extremes, and you totally understand swap dealer intermediation. But today we're adding the missing macro capstone to your strategy in this explainer. We're going to bridge that gap between weekly speculative positioning and the broader economic regime, which is going to fundamentally transform how you evaluate your setups. Okay, let's just briefly run through today's masterclass syllabus. We're hitting 1, the macro trap. 2, gold's cycle phases. 3, the CAPI index explained. 4, adjusting trade signals. And finally, 5, your weekly trading checklist. Let's get right into it.
Starting off with Section 1, the macro trap. Same extreme, but radically different outcomes.
So picture this. You're looking at your screen and you see managed money heavily crowded long. The COT index is sitting way up there above 85. Now, consider 2 radically different outcomes born from that exact same signal. In scenario A, you take a short position and gold drops, a mild 5% before just rocketing right back up to new highs. But in scenario B, with that exact same reading, gold collapses 25% into this brutal multi-year bear market. It's the exact same extreme, but a totally different reality. Crazy, right? Here's the crucial takeaway. Amateurs tend to trade that COT extreme in a complete vacuum. They see an 85 index, and bam, they blindly hit the sell button. But professionals? We use the business cycle as our capstone. It tells us how vulnerable the market truly is. Essentially, the cycle dictates whether gold is going to act like a cyclical commodity just riding a growth wave, or if it's acting as a safe haven that's about to get aggressively liquidated. Moving on to Section 2, gold's cycle phases. This is where gold essentially acts as a chameleon. Notice how gold completely shifts its identity depending on the macroeconomic weather. Just look at this breakdown. During an expansion phase, gold actually tends to lag behind silver, and bear COT extremes usually only trigger pretty shallow corrections. But transition into late cycle, where we have rising inflation, that is gold's sweet spot. It dramatically outperforms. Now, in a recession, it surges initially as a safe haven, but you really got to watch out for those forced margin call liquidations. Finally, in early recovery, gold is often heavily undervalued. And honestly, that's exactly when the smart money starts quietly accumulating it. Okay, Section 3, the CAPI index explained, the cross-asset positioning index. So because GDP and inflation data are, lagging indicators, we desperately need a real-time tool to identify these phases as they actually happen. We build this proprietary index by looking at the weekly managed money positioning across 4 specific cross-asset markets. We aren't just looking at gold in isolation anymore. We monitor gold as our fear gauge. We look at 10-year treasury notes to see what speculators expect from yields. We watch the S&P 500 E-mini for growth sentiment, and we absolutely have to watch copper, the quote-unquote PhD economist of commodities, to gauge global industrial demand. Here is exactly how you build the cross-asset positioning index, step by step, so you can calculate the market's true macro narrative way ahead of the curve. First, you calculate the standard 3-year COT index for all 4 of those markets. Next, you convert each of those into a normalized cycle score, ranging from -1 to +1. Finally, you just compute the average of those 4 scores. That average? That's your CAPI. By tracking the multi-week trend of this final score, you can literally pinpoint the macroeconomic weather. If your CAPI is deep in the negative, between -1 and -0.3, you're in an expansion. Between -0.3 and +0.3, that's late cycle. A high positive score means recession. And when that high positive score actually starts actively declining, boom, you are in an early recovery. You're now anticipating dangerous regime transitions way before the mainstream financial news even prints a headline. Section 4, adjusting trade signals. How to amplify or mute your setups. This right here is where the theory turns into pure tactical execution. Before you place your next trade, you have to ask yourself this fundamental question. How do we use the macro regime to amplify or mute our COT trading signals? Think of the COT signal as the engine of your car. But the macro regime, that's what's telling you whether to step on the gas or slam on the brakes. Pay really close attention to this 1.3 times multiplier. Say you get a bearish COT signal on gold, and your CAPI tells you you're in late cycle. You'd multiply that signal's weight by 1.3.
Why? Because in late cycle, inflation is hot, the Fed is tightening, a bearish signal here is heavily amplified, meaning the potential for a severe, violent correction is incredibly high. You definitely want to be aggressive on the short side here.
On the flip side, what if you get a bearish signal during an early recovery phase? Well, it's heavily muted by a factor of 0.6. Why is that? Because during early recovery, smart money is accumulating and the structural flow is pointing straight up. In this scenario, you should really dramatically reduce your position size or, honestly, just ignore the bearish signal entirely. Now here is the absolute ultimate setup. A bullish COT signal occurring during an early recovery phase is amplified by 1.4 times. Guys, this is the holy grail. The market has completely washed out, the smart money is quietly buying, and the macro regime is shifting to support growth. This offers one of the absolute strongest, highest conviction long trades you are going to see in the entire business cycle. So the practical application here is adjusting your maximum risk budget per trade based on these structural edges. If you're in an expansion, where we know gold tends to lag, you cap your risk at 1.5%. But when you hit late cycle or early recovery, when the cycle and your COT signals are strongly aligned, you can confidently risk up to 2.5% of your account. You're essentially pressing your advantage when the structural wind is firmly at your back.
And finally, Section 5, your weekly trading checklist, integration and routine.
You know, knowledge is great, but consistency in application is what actually makes you profitable. I highly recommend screenshotting this pre-trade checklist right now. Every single week, before you place a trade, ask yourself these 4 things. 1. What's the current cycle phase based on CAPI? 2. Is my pending COT signal amplified or muted? 3. Have I adjusted my position size accordingly? And 4. Is the multi-week trend of the CAPI confirming or contradicting my trade? Doing this systematically filters out the garbage and lets you execute with the total confidence of an advanced macro edge. The cycle is always turning. With this capstone, you will turn with it, and ahead of the crowd. This core philosophy reminds us exactly why we do this extra work. The standard COT report gives you incredible focus, letting you see exactly what speculators are up to. But the business cycle? That gives you true depth perception. It lets you see if that wave coming at you is just a ripple or a massive tsunami. I want to leave you with a thought. Take a look at your current positions right after this explainer wraps up. Run them through the CPI index today. Will your next trade be blindly executed in a vacuum, or will it be strategically amplified by the macro regime? The cycle is always turning, my friends. Make absolutely sure you are turning with it.